Hey everyone, welcome back to the channel. Today, we're diving into a topic that's on a lot of people's minds: selling stocks. Specifically, we're talking about timing the market and why trying to sell at the perfect moment can often backfire, leading to some serious hidden costs. We'll explore why now, especially during a down market, might not be the best time to sell your investments. So, let's get straight into it. You've probably heard the old saying, buy low, sell high. It sounds so simple, right? But in reality, it's one of the hardest things to do in investing. When the market is volatile and headlines are screaming about downturns, our first instinct is often to panic and sell. We see our portfolio value drop, and we think, I need to get out now before it gets worse. This emotional reaction is completely understandable, but it's often the worst move you can make. Let's break down the hidden costs of selling at the wrong time. The first and most obvious one is locking in your losses. When you sell a stock for less than you paid for it, that paper loss becomes a real, permanent loss. If you had held on, the stock might have had a chance to recover and even grow past your initial investment. By selling, you eliminate that possibility entirely. It's like getting off a roller coaster at the very bottom of the dip. You miss the entire climb back up. Another major cost is missing out on the best recovery days. Market history shows us that the stock market's best days often happen very close to its worst days. We're talking about sharp, unexpected rebounds that can make a huge difference in your long-term returns. If you sell out of fear, you're likely to be sitting on the sidelines when these powerful recovery days happen. A study by Fidelity showed that if you missed just the 10 best days in the market between 1980 and 2020, your overall returns would have been cut in half. Missed the best 30 days, and you'd have barely made any money at all. That's a staggering cost. Then there's the problem of getting back in. Let's say you sell, and you successfully avoid some further downside. Great. Now what? When do you buy back in? This is the second, and arguably harder, part of timing the market. Most people who sell in a panic wait too long to reinvest. They wait for good news or for the market to feel safe again. But by the time the news is good and the market feels stable, a significant portion of the recovery has already happened. You end up buying back in at a higher price than you sold for, effectively selling low and buying high, the exact opposite of the goal. This brings us to taxes. Depending on where you live and how long you've held the investment, selling stocks can trigger capital gains taxes. When you sell a profitable investment, a portion of that profit goes to the government. If you're constantly buying and selling, trying to time the market, you could be racking up a significant tax bill that eats away at your returns. A long-term buy-and-hold strategy often has tax advantages because you defer those capital gains until you actually sell, potentially many years down the road. So, with all that in mind, why might now during a period of market uncertainty or a downturn be a particularly bad time to sell? First, valuations are lower. When the market is down, stocks are essentially on sale. Selling now is like selling your house during a housing market crash. You're not getting the full value for your assets. For a long-term investor, a down market is actually a buying opportunity, not a selling signal. It's a chance to acquire more shares of great companies at a discount. Second, fear is at its peak. The famous investor Warren Buffett once said, "Be fearful when others are greedy, and greedy when others are fearful." When everyone is panicking and selling, that's often a sign that we're near a bottom. Selling into that widespread fear is letting your emotions drive your financial decisions, which rarely ends well. The smartest investors are the ones who can remain calm and rational when everyone else is losing their heads. They stick to their plan. What does a good plan look like? It starts with understanding your time horizon. If you're investing for retirement that's 20 or 30 years away, short-term market fluctuations shouldn't faze you. You have plenty of time for the market to recover. Historically, the stock market has always recovered from every single downturn, bear market, and crash. Always. The key is having the patience and discipline to wait it out. Of course, there are legitimate reasons to sell. Maybe you've reached your financial goal, like saving for a down payment on a house, and you need the cash now. Or perhaps the fundamental reason you invested in a particular company has changed for the worse. These are strategic, planned reasons for selling, not reactive, emotional ones. The key difference is that the decision is based on your personal financial plan, not on the market's daily mood swings. So, what should you do instead of selling in a panic? First, take a deep breath and step away from the screen. Stop checking your portfolio every 5 minutes. Second, review your financial plan. Remind yourself why you invested in the first place and what your long-term goals are. If your circumstances haven't changed, your strategy probably shouldn't either. Third, consider a strategy called dollar cost averaging. This means investing a fixed amount of money at regular intervals, regardless of what the market is doing. When the market is down, your fixed investment buys more shares. When it's up, it buys fewer. This approach smooths out your purchase price over time and takes the emotion out of investing. Remember, building wealth in the stock market is a marathon, not a sprint. The real money is made by time in the market, not by timing the market. The temptation to sell when things look grim is powerful, but the hidden costs of giving in to that fear locking in losses, missing the recovery, and the challenge of getting back in are far too high. The most successful investors are often the ones who do the least. They create a solid plan, they stick to it, and they let the power of compounding and time do the heavy lifting. Thanks so much for watching today. I hope this gives you some perspective and a little more confidence to stay the course with your investments. If you found this video helpful, please give it a thumbs up and consider subscribing for more content on smart investing and personal finance. Let me know your thoughts in the comments below. Have you ever been tempted to sell in a panic? See you in the next video.